Hello and welcome to the latest Insider interview. Our guest today is Mohneet Dhir, who is the product manager of Vanguard's LifeStrategy range. Mohneet, thanks very much for coming into the studio.
Happy to be here, Sam.
There are 5 LifeStrategy funds ranging from 20% in equities to 100% in equities. So who are the typical investors in each of these strategies?
It really depends on people's goals and alignment to those goals when they're choosing the right investment for them. As an example, someone like my parents who are in their late 60s, for them, I would say something like a LifeStrategy 20 or 40, depending on their personal risk appetite, would be the right choice. Someone like my son, who's 4.5 years old, for him, obviously, it would be on the higher equity scale, so something like a LifeStrategy 100. And for someone like me, I would sit somewhere in the middle, maybe a LifeStrategy 60 or an 80. So it really depends. However, it's not just age dependent. There are other factors that people may take into consideration, whether it's a goal of buying a house, funding university education, where you have 5 years to save or 10 years to save. And then depending on your time horizon, you can choose what your risk appetite is and what level of equity exposure and bond exposure is right for you.
So generally speaking, if you're looking to grow your portfolio more, you'd have more in equities. If you're looking for a bit more defense from your investments, you'd have more in bonds, fixed income. But why is this? What are the characteristics of each of these asset classes which lead to a defensive portfolio or a more growth-oriented portfolio?
So bonds generally are seen as safe assets or safer assets compared to equities. And that's obviously high quality bonds, right? Investment grade bonds. So LifeStrategy only invests in high quality investment grade bonds, which are extremely liquid. So if you were, looking to sort of redeem from your portfolio at a short notice, it's quite quick and easy to do compared to if you were invested in, more risky parts of the market. What that also means is that it makes a portfolio quite defensive. So usually bonds are quite negatively correlated to equities. What that means is that when equities go down, bonds will protect your portfolio in terms of having a positive return to offset some of that negative return you get from equities. In a normal market environment, you generally do tend to get less volatility as well if you're in a fixed income heavy portfolio, especially if you're invested majority in government bonds, as LifeStrategy is, while also having exposure to high quality credit or corporate bonds as well. So that's essentially your fixed income portion of the portfolio. When you look on the equity side, so if you're going up the scale and you go into LifeStrategy 80 or LifeStrategy 100, obviously, because you have more equity exposures and investors will be able to see equity markets tend to be more volatile. Stock prices are more subject to human emotions, given how stock markets obviously trade, which means that stocks can be extremely volatile on a day-to-day basis. There's a lot of participants in the market. You've got day traders, you've got people who, you've got hedge funds, you've got all sorts of participants that are driving the share price. So in the short term, equities can be a lot more volatile. However, if you're an extremely young person who has a long time horizon, or you have a personal goal which has a 10, 15-year time horizon, you're obviously generally your risk appetite would be higher than someone who's got a 2-3 year goal that they're trying to reach financially.
And you have this very rigid stock bond split. So how do you maintain that, and why is it so rigid? And how often are you rebalancing to keep that allocation? We
try and rebalance as frequently as we can. We're very mindful of costs, as you know. So rebalancing comes into the equation there as well. We want to make sure that when we rebalance in a cost-efficient way. Now, thanks to all our investors and all the support that we've been given from everyone who's invested in LifeStrategy, we've been lucky enough to have cash flows, positive net cash flows, for majority of the time that LifeStrategy has been running since inception. What that means is that we can use cash flows to actually rebalance, which keeps the costs extremely low compared to having to sell existing positions, which really, really helps. Now, so that's the rebalancing element. It's frequent and it's very cost efficient, which again passes more return back to investors. Now, in terms of the stock bond split, the reason that we're so rigid about it is because clients may be using that in different ways. So a client, for example, who's invested in LifeStrategy 40, for example, could be using LifeStrategy 40 as a core of their investment portfolio, which means that, you need your core to be stable, to be predictable, to know what's in there. However, if we kept moving the goalposts and we kept going from LifeStrategy 40 to LifeStrategy 50 or 45, it wouldn't quite have the same effect for that investor, because that means it would either put the risk up or down for their entire portfolio, depending on obviously what else they're invested in and what other assets they have exposure to.
As you alluded to there, it's often a core allocation for investors. Actually, some people might just own one fund, a LifeStrategy fund. They just allocate to stocks and bonds. There are other asset classes as well. There's real estate, there's private equity, there's commodities like gold. So why do you avoid those, and why do you just stick to stocks and bonds in this range?
Yeah, so I don't think it's sort of as clear-cut as people think it is when it comes to investing in other asset classes. For us, if we were to introduce any other asset class into LifeStrategy, it would be a question of risk return. So any asset class coming into LifeStrategy, if the potential risk that you're introducing into the portfolio is higher than the additional potential return that you get, then it doesn't make much sense for us to do that. If anything, it wouldn't be fair on investors, because we're introducing more risk into their portfolio without giving them additional return. Now, the other element to think about is something like real estate. Through global equity markets, investors already have real estate exposure. They even have exposure to commodities, may not be directly through commodity futures or something, but you do have exposure through companies that are operating within that arena in global equity markets or in the global bond markets. So you are getting exposure to those asset classes indirectly, but just not in the way that people are more familiar with.
In the LifeStrategy 100 funds, about 25% of the equities are UK equities. This compares to between 3 and 4% for a global developed market world tracker at the moment. So you have this home bias, you're overweight the UK. Yeah. Why is this? And is this a conscious decision to be overweight the UK? Yeah,
so the home bias is really a result of client preference. We've done a lot of research as well from a sort of from a wider perspective as to why people prefer to have a home bias. What effect does it have on your portfolios over the long term? How do people apply a home bias? And there's a lot of actually independent authorities that do a lot of research on this as well. What's quite clear to see that not just in the UK, but in the US, in Australia, and many other economies, people do have a preference for investing in companies that they know of. So someone in the UK, for example, will be much more familiar with Tesco's than they will be with Walmart, for example, right? It's a name that they know and it's a name that they understand. So they might be more comfortable investing in Tesco than they are in Walmart. Now, the problem is if you're fully focused in your home country, which is if you only have exposure to the UK, you don't get that diversification. So what we're trying to do with LifeStrategy and through the home bias is find that sweet spot, or find that balance, if you will, where investors get that diversification through being invested in global markets, but still have an element of home bias, that sort of familiarity and preference that they have shown to us since the inception of LifeStrategy. Now, obviously, having said that, we do a review on home bias every year, so it's an annual review. So every year we do a pulse check on, has that preference changed? How has it changed? Has it gone up? Has it gone down? And as a result of that, we would then reflect that in LifeStrategy. But obviously over the last sort of 10 years or so, we haven't really seen much of a change in that preference.
So that's likely to stay at around a quarter of the 100 funds. You haven't changed your view on the UK despite the underperformance relative to the US over the past decade.
Yeah, so I think if you look at the performance on bonds and equity side, obviously the last few years have been difficult from a performance perspective. However, the UK has performed well in the last sort of year or so, the last 2 years, in fact, I would say. And part of that has been sort of recovering from the previous few years. And now when we talk about the US, actually, funny enough, US equities are sort of, the target for a potential valuation correction, as the market is expecting. In a situation like that, obviously, having this exposure through LifeStrategy will help investors. So again, you can't always, it's really difficult to know which asset class or which part of the market is going to be the big outperformer in the next 5, 10, 20 years. And it's really difficult to predict that. Some of the best fund managers can't do it on a consistent basis, which is why having that global diversification, despite the home bias, you still are exposed to a lot of other markets and stocks and bonds, which gives you that diversification to not having to make those decisions and rely on the sort of wisdom of the broader market.
I think when people think about doing a core allocation to equities, LifeStrategy 100 is often in the conversation. So is a global market cap weighted tracker fund with maybe just 1,500 companies with the big US tech stocks at the top and a few UK companies nearer to the bottom. What are the advantages of choosing the LifeStrategy fund of fund approach to just a simple market cap weighted index tracker?
Yeah, so there's different pros and cons for both sides. For LifeStrategy in particular, the way that we think about it is that, we use different building blocks to get the equity exposure that we do have through LifeStrategy 100. What that obviously provides investors, which they wouldn't get in the one single product that they buy in, is that product diversification, right? And you're not exposed to potentially, Mag 7 taking over your entire portfolio, as some investors will be exposed to. So building that equity exposure through different building blocks does allow us that sort of, being able to introduce more product diversification into a client's portfolio, which they won't necessarily get otherwise.
The fees on the range are 0.22%. It's competitive, but there are cheaper options out there for investors. And that's been the fee since launch, I think, more than 10 years ago. So will that stay at that level, or are there plans to actually reduce the fee given the assets that you've generated?
So we've actually cut the fees more than 3 times since launch. That was a result of the funds growing and us finding more scalability in the processes that we use to run LifeStrategy funds. And obviously the funds are growing, which is great. The funds growing more essentially means that it gives us more room to be able to cut fees. The LifeStrategy funds, along with pretty much all Vanguard products, go through a rigorous value assessment when it comes to pricing. And we're continuously looking at, making it more efficient, and where can we cut costs, where can we sort of, finding ways to try and cut costs. And as most investors will know, Vanguard's been a leader in that space for so long. The Vanguard effect, as everyone likes to call it, is, coming into a market and lowering prices for everything. And we do hope that in the future that we can cut the cost for LifeStrategy at some point, but we need to be able to get to a sustainable level of assets where we can find more scalability in order to be able to cut those costs. Because for us, that direction, it's only a one-way direction. We are never going to, our aim is never to increase costs. Our aim is always to cut costs. And we want to be in a position to be able to do that for LifeStrategy as the funds grow in a scalable way.
And finally, the question we ask all of our guests, do you personally invest in your funds?
I do, and my family does as well. I'm in LifeStrategy 80, and my son is in LifeStrategy 100.
Mohneet, thanks very much for coming into the studio.
Thank you so much.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.